Hi, I am Dimitri from Silver & Young Private Wealth, and I'd like to welcome you to a new episode of Behind the Wealth podcast. We explore, investigate, and analyze topics of wealth creation.
Hi, this is Dimitri from Silver & Young Private Wealth. I'd like to welcome you to our new episode, Behind the Wealth. In the previous episodes, we have dealt with the concept of fattening the purse by saving or put aside for reinvested the 10% of our salary or wages, or a particular percentage from the top line. It depends on your margin rate if you are an owner, a business owner, or a sole trader. And then we had the other episode after that regarding the 10%, what we do with that, where we invest them, in what areas we can invest them and take advantage of this money to help them grow for our future financial certainty in the future. And then we talked about some extra rules about the 10%, how do you invest. On I think on the fourth episode, we talked about risk and what is the concept of risk and what different risk different investments have that we need to consider before we go and invest. Today, I would like to talk a little bit about the lifestyle protection. And in everything we do, there is an effect that it comes for every action there is a reaction. And for example, I will use the example of buying a property. It doesn't matter if this is property is our first home or it is an investment property. At the end of the day, we consider this transaction of buying a property a financial transaction. And this is have certain risks related to this financial transaction. Don't forget, buying a property for you to live as a primary residency, although it is a necessity because otherwise you need to rent a property, but on the other side, it still is a financial transaction that we want to have the maximum benefit and also mitigate or minimize any risk associated with this financial transaction. And this is the reason also, and this is one of the steps of building and creating wealth, that in every step we do, you need to calculate or somehow have a real good concept of what is the potential risk, accommodate the different scenarios that we can protect that or minimize this risk, and then take an action to go forward or not. So if we use an example, for example, of buying a property for $800,000 and we have $200,000 somehow as a deposit, doesn't really matter if it's an investment property or it's your primary residency, your home, we have a loan of $600,000. And the first consideration is what risk is associated with that. If I'm 30 or 35 or I'm 50 or 60, it doesn't really matter, but it has different outcomes. I would probably say we need to consider what is the difference if there is a problem. So if I have a $600,000 loan and I go suddenly and I bought the property, I put $200,000 of my own money, $600,000 I get a loan, which I need to do repayments. And I want you just to go through and analyze a little bit what is the risk associated with these issues. So one risk is, of course, the price of the property to go down in the next few years or in many years after we purchase it or go nowhere. Of course, we aim for the property to double every 12 to 15 years, at least in Australia. And that's what we hope. But there is a risk for the first 2, 3, 5 years, the property do nothing or even worth less than it is. It depends where we bought it on the property cycle. Then there is other risk. What about if I cannot pay my or meet my repayments requirements for my mortgage? What it happens if I get sick or ill for a short period of time or relatively longer period of time than I expected? Then the other thing is, what about if I get seriously ill for a long period of time? What about if I lost my job? how I'm going to meet my repayments of the $600,000. Another part of risk it is, what about if the property, if it's an investment property, my investment property is vacant and I have no tenant? So who's going to pay me this $400 to repay to be part of my repayments? And another very important, especially for younger families, it is, what about if I die? So let us go to one by one and try to analyze a little bit the different risk issues we have by purchasing property. So the first risk is, of course, what about if the price goes down? This is always a market risk, and it's a systemic risk, they call it. So it's a market risk that if the property cycle, it is on the downtrend and starts to go down and we bought on the peak, yes, that's a really serious risk. The issue for that is then the cash flow, and if we can tolerate that risk, if there is no other issues. Say if we work and we have health and we are healthy and we do everything, it's all fine. It's nothing really big catastrophic. It just is the price goes down for a little while. It is really matter. If it is your primary residence, probably you can't avoid it in your lifetime. In your lifetime, you buy property in 2000, in 2006, 7, 8 was going very well. In 2008, the properties dropped, and 2012, 13, and then 2013, 14 went up again, and now they are really on a very high level. And obviously, it's going to happen this again, and in a 2 or 3 years' time, the properties maybe drop again, and off you go, the next cycle and the next cycle. But this doesn't affect you if you really is your primary residence, because what is the alternative? The alternative is you needed to rent. So you can't really don't buy property because maybe the property drops a little bit off the price that you purchased it. As this is a lifestyle decision, and you need to live somewhere. So it is part of your necessity. Now, if this property was an investment property, you need to have the thought that the property is going to be as an investment, not looked less than 12 to 15 years time frame. So if in your mind is, I'm going to buy the property today and sell it in 5 years time, I think you should not consider this asset class, consider something else, because the property usually deliver the best outcome at the end of the cycle. So if you're lucky and you purchase after a bear market of the property or a drop in the prices, that's very good. You're going to have instant gratification that you are a genius property investor. But if you are not that, and you bought it in the middle of the cycle or at the top of the cycle, you're going to have the downtrend of the property cycle and then have the experience of going back again and recapture the losses that you had, and then obviously do extra profits later on the cycle. So as a standard, if you are not a developer, the property it is for at least 12 to 15 and even longer time period as an investment to mature. It's like a wine, especially designed to be drunk in a 6 months, in a year, in 2 years time. And then the other types of wines, they need to mature 3 or 4 or 5 years and beyond to be at the best. It is exactly the same analogy with the property. You need to have time in front of you, and the risk of the prices goes down and up is part of the landscape of the investment, and you need to make sure that you're happy with that scenario, because really you can't control. And then if you have that fear, then you will never able to buy a property in case the price of the property drops. The second thing is, what about if I cannot do or meet the repayments of the loan? So due to the illness. Now we have a little bit of issue here. If, for example, I'm an employee and I work with an accounting firm, I'll probably have 20 working days as annual leave, so a month roughly. Maybe I have 8 to 10 days of sick leave, so roughly 30 working days. So if, for example, I break my leg by doing or fixing the gutters on the house, and I'm out of action for 6 weeks because I can't drive, or I can't get the stairs up, or I'm in the hospital, then their annual leave and my sick leave, we accommodate my wages because I have this accumulated over a period of time with my employer. Then in 6 weeks' time, probably I'll be okay because I only was without wages a week or so. But if this for his illness is more than 6 weeks, or I don't have enough annually, for example, from the start, I just changed job, then I'm very vulnerable to that. I won't be able to meet the repayments of $500 a week, for example, for servicing the loan of my new home or my new investment property. So this is where it comes then, the risk mitigations, which is through income protection insurances. And what it does, it protects your income 75% of your income at the maximum. And then there is a waiting period. You can wait before you make a claim 15 days, 30 days, 60 days, 180 days, sometimes 2 years if it is needed. And what is the reason for waiting period? The longer the waiting period it is, the cheaper, of course, it is, because the little incidents to break your leg and wait for 6 weeks and go back to work, if you have a waiting period of 60 days, then you can't have a claim, compared to another one that is 15 days. And why we do 60 days and not 15 days? 60 days we make it because usually we have reserves, the wives or the husbands or the other halves or our better halves working, so they can somehow sustain their loan repayments, or we have enough annual leave, so people who work in Qantas or in a big fours or Telstra, that they have long period of working there, 10, 15, 20 years, they have sometimes 90 days, 100 days of annual leave and 30, 40 days of sick leave. So these people, they don't have the needs like someone who just started or changed job with a new employer, has accumulated annual leave or sick leave to accommodate for the insurance. So the problem with that insurance, income protection insurance, is that only has 75% securing your income. So if you earn, say, $100,000, they secure you for $75,000. That's it. You can't secure more than that. Which is, in reality, it is a little bit of issue, but that's the regulations, because the insurance companies, they want to motivate people to go back to work. So they don't provide 100% cover, they provide 75%. The other thing is, what about if lost my job? Unfortunately, there is no really cover for that. If you lost a job, you need to find another job. And if your another job is not as good as, or financially good as paying you money as the old job, then you need to drop your level of expectations and move to a job that is a little bit less paid till you settle and you find your feet to go and find another job as the previous job or with a better pay. So there is no really way to push your risk to someone else if you lost your job because you resigned or you are redundant or whatever, the business is closed. Unfortunately, there's no way out of that. The income protection protects you for your income and gives you 75% of your income when you have a major illness, an accident, any reason you can't go to work because you can get a medical certificate, you are not able to go to work because of that illness or accident. It doesn't really matter what it is. You could play soccer and you break your leg, or you could do working and you break your leg, or you could do fixing your home and break your leg. It doesn't really matter. The reason that you broke, the issue that you broke the leg and you can't go to work qualifies you to claim for the insurance. But then what about the risk of the property? You see, by having 75% of that coming back to you when you don't have to work because you're sick, obviously, then you still can meet your repayments. So you still can pay the repayments. And then how we see what is more important for the client or for you, personally, you have to see compared to different situations. Say, for example, if I'm married and my wife earns $50,000 and I earn $50,000. So the contribution of the both of us to the family, for us to the livelihood, is almost the same. So the family doesn't rely to me on 100% rate or to her. Now, consider the different scenario. If I am not working, but my wife is the one who's working, and she's the breadwinner of the family, and for some reason I'm not as good in producing them as her, and she earns the $100,000, and I'm just in between jobs all the time, then the risk is different. There is not much risk on me because my family is surviving with her wages or her salary or her income. So there is much risk if I break the leg, it's going financially won't be able to pay my mortgage. But it's a lot of high risk with her if she breaks her leg and she can't go to work and she doesn't have enough sick leave or annual leave, then we really stuffed because we can't really go and pay or meet the requirements of repayments of the mortgage we have. So another thing we have to consider, there is enough reserves. Say, for example, if I have enough money on my other bank account for a year, 2 years, I have $20,000, $30,000 in my bank account invested, or I have a share portfolio, and I have exactly the same $600,000. The calculation of that need of risk to get this insurance to cover the need and minimize my risk, or how to manage my risk really, it is a bit different. The reason is I have reserves. Okay, I don't have annual leave or I don't have sick leave, but I have $30,000 in a share portfolio that can always liquidate for a short period of time, liquidate to meet my repayments for a short period of time. So each individual and each case is a little bit different. But what I'm trying to get at this point is one risk is we don't have income to pay the repayments. And the solution to that, one of the solutions to that is to have an income protection cover for my income or the significant one in the family that contributes the maximum part of our living expenses. And that's where important is the budget. Because the budget, what it does, it says the wife produces 60% of your living expenses or contributes, and the husband contributes 40% of the living expenses. So we need at least to cover 60% of her income and 40% of his income to meet this requirement. So every case is different, but the basics is this. To have a risk, push it to an insurance company that if something happens to you due to an accident and illness, they can pay you for the rest of your life, up to 65 sometimes, or for 5 years or for 2 years, it depends. The 75% of your income to meet your repayments of your wages. What about if I have an investment property and the tenant, I can't really rent the property for a period of time and the tenant is out and I can't replace? This is a serious problem for investment properties. And the reason it is a problem is because when we buy and we are in the journey of investing and we have the euphoria of, I'm doing the right thing, I'm moving on, I did the right advice, I had the right advice, I did the loan, everything is fine. We always over-optimize or become over-optimistic about everything will go usually well. And one thing a lot of times people forget is the vacancy rates of any rental property. And that usually the work has to be done before you do the advice or before you do the decision to invest in an investment property. For example, what about if the property is vacant for 2 weeks, 4 weeks? The standard scenario is a property could be vacant 4 weeks per year. Sometimes we put 8 weeks per year if it is a regional town or a bit of area with less population and demand. And then if the figures, if we have the cash flow sustainable and it's possible, even if we don't have a tenant for 4 weeks, for example, or 6 weeks or 8 weeks, it depends on the situation, and then we still meet the requirements, then the box is ticked. We can go ahead and go and buy this property because we consider that risk of the rental vacancy. We know how to act with that particular risk. We have a plan because my cash flow sustains. I have enough reserves on the side to sustain that. I have landlord insurance, for example. If they do malicious damage to the previous tenant, and they're going to repay me for that repairs and for the time I wasted for repairing the property. So I ticked all these risks. I addressed them, and I'm happy with the result. And hopefully I will never face it. And I have a very good tenant for 3-4 years, and not need to have a not issue with not paying the rent. The other issue we have to deal with, which is also very important, it's what about if I die? I know this is a bit of doom and gloom, and nobody really wants to talk about doom and gloom issues because every one of us would like to talk about positive things. But this is part of the reality. And a lot of people I know from personal life, and I know from the clients that interact, death is coming in a very, very unexpected way and a very unexpected time. And always we need to be consider that it's going to come in the most, when we are most vulnerable and unexpected. So if I purchase a property of $800,000 and I have a loan of $600,000, I work $50,000 a year. My wife works for $50,000 a year, and we manage, and we have 2 children or 3 children, and I'm 30, 35. What is the risk? There are several risks. Number one, if I die, my wife, then you ask the question, is my wife able to meet the repayments of that loan and go on with her life? The second question is, do I want my wife to be debt-free if I die? So do I want my wife to be debt-free if I die and be all the debts paid off? Surprisingly, some of the clients, they say, no, I don't think it's important because she can sell the property and downsize the property. So there's no right or wrong question. If the property is worth $2 million, you can downsize and buy a property with $1 million. So we don't need to cover for the total loan. The other thing is the 2 or 3 children I may have. Say, if I have 3 children, 2, 4, and 8, what impact has to that if suddenly I'm not earning my $50,000 or $100,000? And the other issue is, okay, one scenario is both partners, they have equal contribution to the home budget or to the family budget. What about I am the main earner, $100,000, and my wife, because she just had the new baby, she's out of work for a year, 2 years, 5 years, still she goes back to work. And then for 5 years till the kids go to school, the youngest, and then she goes back to work. So what is the risk for that if I die? I mean, she has a $600,000 loan, she has 3 young children, and she has to go back to work. So of course, the solution to that is quite more complicated and more needs to be addressed in the peculiarities of the special situation of each person. But I'll give you an example. If, for example, the wife has, the husband dies and the wife left with a 2-year-old child and she can't go to work. If she has a big and supportive family, has less need to have insurances to cover this debt if the family is very close and can support it all the way. Usually this is not the case because even if the family is supportive, they can't really bail out hundreds of thousands of dollars to the member of the family. So the usual case is that the wife has somehow all work, go back to work and meet the repayments of the loan by herself. Or the second thing is she needs to downsize because she can't afford the property. Or the third one is, of course, to have an insurance policy, a life insurance policy. So if that person or the husband dies, then the property is paid off with the $600,000. So it is debt-free, and then the wife only concentrates, or the other spouse only concentrates to go to work and make the $30,000, $40,000, $50,000 living expenses that she needs to have to feed the family and raise her family. Now, if this property is not your primary residence, it's an investment property, it's always the question has to be asked, do we need to keep the property for the family or for the people who stay behind us? Or we can sell it, pay off the loan, take whatever profit or loss it is, and close the subject. This is also has to be considered and evaluated what is important to you or to the person that we deal with. And this is also very important to think that there is no right and wrong. It is what it is right for the circumstances of the individual and the couple. The other question it is, what about if, for example, I don't die, but I have a serious accident and I am incapacitated and I can't go to work and I'm bound in a chair or in a bed. What's happening? This is also very serious because you see, if I die, it is a wound, but it's closed by time. My wife, she will say, Dimitri was a good man, was a bad man, God bless him, whatever. But the wound by time is going to close and she's going to move on. And my kids the same. It will be a memory, a nice memory, hopefully, but they will move on. But what about if I'm not dead and I'm rebound in a bed or in a wheelchair? What's happening? I am an open wound. And we're talking financially. Nobody wants to die compared to being in a bed for a person who loves, but just we're talking financially. So financially, I am an open wound because my wife cannot go to work as if I'm healthy and alive. I am an emotional burden most of the time because I'm dealing with my own issues and she has to deal with me as well. So there is also that need. What we do with that? If I have a $600,000 loan and the main earner of the family or the big contributor of the family income is incapacitated. So this is also a risk we need to address, which we address it with terminal and permanent disability. And there is few issues and scenarios with that. We don't address them now. You can get these insurances out of your super, get paid by super or pay by yourself. And there is calculations and where it is more beneficial to do this way or the other way. The income protection also, it is deductible if you pay it out of your pocket because it protects your future income or your current income, or it is deductible if you do it through your super fund. But this is the final details before you do the need analysis of do I need to have that insurance and cover that risk as the subject matter we have now we're dealing. So, and of course there is another risk. What about if I have a major heart attack? What about if I have a prostate cancer? Or if I'm a female, I have a breast cancer? What's happening in this scenario? And you know, I've seen this through clients and people in my immediate family that they had an issue with that. And you know what it happens? You're paralyzed. Your mind goes to totally shocked and you don't know how to deal with that because you don't know if you have in front of you a month, 2 months, or 6 months, or a year, or 5 years. And all the worst scenario comes to your mind. So we ask a lot of times the clients and we say, okay, if you have a major illness, do you want to have a lump sum payment to deal with that illness for extra hospitalization or extra medical treatment, or to pay part of your mortgage, or to have a lump sum payment to deal that you don't need to go to work, you just stay home or do anything else, do whatever you think because you are really in a stress mood. And this is usually they call it the trauma insurance. Every part of these risk mitigations has a cost. And that's also a very important thing to consider. We need to consider the cost and the benefit. We need to consider why we need it. We need to consider, okay, if we need it, in which way we acquired, inside super, outside super, pay out of pocket, for different tax reasons and other reasons, for cash flow reasons. A family that she buying just have a loan of investment properties, it's not the same as a family that just bought the first home. What insurances we need and how much we need it. And also, the other thing I want to talk about, all these risk and lifestyle protections and risk mitigation steps that we take, they're not set and forget. The reason it's not set to forget because, okay, I was 35, I bought a house of $800,000, I owe $600,000, everything else is wealth, I'm investing in share market, I bought another property, but this is the main thing that I want to protect for my family for whatever reason. And I have 3 kids. They are 2, 6, and 8. Okay, 5 years later, when my youngest is not 2, but is 7, 8, there is less risk than 5 years ago because it's 5 is a lot closer to stand on his own feet or her own feet if something happens to me, number one. Number two, maybe I dropped the loan. It's not $600,000, especially if I was paying principal interest, maybe now it's 500, 550, 520, 400. So why do I need a $600,000 loan or more, sorry, insurance or more, when my loan is only 400 now? So we need this to review probably every year, not probably, most likely every year. It only takes 20 minutes, half an hour to sit with someone who says, okay, I have this, I have this, I have this. Yes, I need this, I need this. This is changes. My income is increased now. I need to protect more income. Or my income has decreased. I don't need so much protection because my income has decreased. My loan has increased. I need more protection. No, my loan has decreased. I need less protection. So all these are variable and movable parts of how you manage your risk. And a lot of people forget about this issue. They just go, they get it, they say it's okay, it's extra. I have insurance for $600,000, and the $600,000, it was my loan 10 years ago, and now it's almost $300,000. So it's okay, but it's not okay. If you don't need it, why you pay premiums? If you don't need it, why you don't take these premiums and invest it in another parcel and be part of your 10%, make it 11, 12% to fatten your purse? So all this needs to be addressed on a yearly basis. Have a review on a yearly basis to see if it is worth it to have the current risk mitigation strategies or the plan to minimize your risk if something goes wrong. So the moral of the story today is, if you buy a property, as part of the first conversation, talking about the risk, we have the risk of the price to go up and down. Really nothing you can much do, especially if you're primary residency. You just hope you bought in a good area. Secondly, if it's investment property, you should done the homework before, cash flow. Then there is an issue with the vacancy. If you each rent a property, you need to do this homework before you buy the property. Then there is an issue with the actual loan, the $600,000 as we said. And what we have, the risk. What about if I lose my job? What about if I get sick? What about if I get long time sick? So not just for 6 weeks or 10 weeks. Then we have the income protection insurance to deal with that mainly. Then what about if I'm a terminal disabled or I'm a terminal ill or permanent disabled? Then what I do with that? How to mitigate these issues with my family to have the less financial impact for them. And then of course we have, what about if I die? What's happening? How well protected is going to be my family that's left behind? Now, if I'm a young couple and I don't have kids, it's a different scenario. I should said it before. So, and then the final thing is, of course, to put all together to make financial sense and not break the bank. The reason is you still need to repair your home, you still need to invest, We said already you take the 10% out of the equation, so you're working only with 90% of your income. So this has a big effect on your lifestyle as well. So we put all together, we get the quotes, and then we say, okay, this is the ideal. This is the minimum. This is somewhere in between. And then we work which one it is more comfortable, knowing from now that we can't deal with every possible worst case scenario, because then we need a really bank account to deal with that. And of course, it's opportunity cost. Hopefully, you will never claim for life insurance and die long at 90 and 100 years old. So you never leave your family, and hopefully you never have the need to be out of work due to illness or an accident, and substantially long time, more than a week or so. So, and hopefully we don't get terminally ill or disabled. So the majority of us, really, we don't have the need to claim. The problem is when the need comes, you need to be already protected. And why it does this? It protects, so every time you go a level up on your investment, on your wealth creation, you need to accommodate these issues of have a buffer. So now I'm here and I'll protect myself. That's the bare minimum I could do, because I can't do anything more. Then my investments and my wealth went up, then I raised the protection a little bit. And then my wealth was up, then a wealth protection might be, if I want so. So if I fall up to here, I don't fall back there. And this is a calculation then where I put my protection to be here or here or here. And this is, of course, a very private matter, a very individual matter. What is worth for you and what's working for you is not going to work for your brother or your sister or your best friend. So this has to be assessed on individual level, because every one of us is different. Everyone has different family requirements and needs, different financial strength. I hope you liked the new episode Behind the Wealth. If you like it, please click on the little bell to be subscribed so you get a notification when we do the new one. If you have any questions, please email us on pw@silveryoung.com.au, P as private, W as wealth, at silver as the metal, young as the youth.com.au, or give us a call. Till next time, have a good day.
I hope you have enjoyed our recent episode Behind the Wealth, provided to you by Dimitri from Silver & Young Private Wealth. If you have any questions regarding our recent episode, please email us on pw, P for Peter, W for Word, @silveryoung.com.au. Until next time, have a good day and enjoy life.